How are you, friends? I'm Mark Dutram, coming to you with another episode of BayView Views. Today we're going to give you a little bit of a market update and talk a little bit about inflation. You think about it, how did we get here? We are, I think, 20% down in the S&P as of the time of this video, which would technically classify as a bear market, right? Prices being up more than 20%. Hard to think we'd be there because January, if you think back, during our reviews, we talked about the markets were really priced for perfection. Lots of things were good. Earnings were good. No really uncertainties that we had to face. And now, again, we talk about the Fed taking up so much of the media, and it's trying to cool down, again, a rather strong economy with finally contractionary monetary policy. I say finally because, again, we believe this is needed. The economy should be able to stand on its own without, rates at zero. And we've been having easy policy, both fiscal and monetary policy, for quite some time, and that's also contributed to the problem. So again, we've got a rather strong economy with, again, stronger demand than supply can keep up, which is obviously what's causing inflation. So you add to that this year the Russia-Ukraine situation, and that has contributed additional inflationary shocks to both food and energy. And not to mention then, now you have another uncertainty, which markets don't like, of the contagion effects of this war and how long, does it last and the spread. You add to that the supply chain disruptions that really have been in effect globally since COVID broke out. But primarily where we're seeing the ramifications are in China. As they try to enforce a zero COVID policy, it's causing an effect in so many industries. And we'll have to see how that plays out. They're starting to ease a little bit, and we'll talk about that. As a result of COVID, we've even experienced that in our own practice. Many people, about 2 million actually, have decided to retire. They just said, yeah, I'm going to pull out of the workforce and retire early. And that put some significant constraints on already a tight labor market. So that contributes to, very tight effects. But right now, it's unusual. We've never had it before, but there are 2 jobs available for everybody that wants one, which is an incredible imbalance. And that's providing what we call a wage push inflationary pressures for companies now because they've got to pay more. You look at the quit rate and all of those things. So all of these forces are working together right now to create, again, some of the highest inflation that we've seen in 40 years. So when we step back then and say, how is the Fed doing in its efforts to combat, these inflationary pressures? Well, when we start looking around, we see that commodity prices across the board, and that would include oil, are coming down, which is a good sign, right? They're being successful in curbing prices there. So we should see prices at the pump even really start to go down a little bit in the second part of the year. Now, we've still got some real limitations in refining capacity, but we also have lower gas consumption year over year based on new adoption to EV standards and things like that. So we also see retail sales coming down, and although people are still spending quite heavily on travel and airlines and leisure, this is probably their therapy for themselves, this self-prescribed, because we know their consumer sentiment is not good. It's probably at a multi-decade low. When we look at housing, so new and existing home sales have decreased again, and they've been coming down with obviously the increase in interest rates and the uncertainties of the economy. Now, prices, we know, remain stubbornly high, and because that's a very significant dynamic with the low inventories and still historically low levels. When we look at inventories at particularly retailers for discretionary items, we know that people during recessions move to more staple purchases, and some of the discretionary items now are building up And so what we might see is some very aggressive price reductions across the board, Walmart, Target, Amazon, those kind of things, as they start to unload some of these discretionary items, which would, in a sense, be disinflationary in and of itself. We do see that supply chain disruptions are finally starting to ease. We can look at port traffic and activity and see that, this is affecting many different industries. Employer expansions. There was a lot of hiring and expansionary focus, and a lot of that's being curtailed now, just due to the uncertainties in the economy. Well, that's kind of relieving some of the price pressures that we see in wage growth. When we look around the economy today, there are probably more inflationary fighting regimes in the global economy than we've ever had before. And I think collectively all of those will be quite successful at curbing inflation. So we do see on the good news that it is working already. Not normally, you want the economy to continue to expand, but again, to get inflation in line, and then that means that the Fed may not have to be as aggressive as we thought they would be in the long run. So we see it as already working. And guys, there's going to be a correlation that goes together. You can't have a contraction in the economy without having a contraction in equity markets, right? It's going to price in that uncertainty. So remember, if you look back at the beginning of the year, we were priced for perfection. And there are many forecasts now for recessions, and that tends to be the case. When one guy forecasts it's contagious, and other people say, I'm going to increase my likelihood of a recession as well. But I think even if we have one, which we very well could have one in 2022, they happen, again, in a consistent basis. I think because we're coming from a position of strength, that they'll be modest. It'll be a mild recession, and probably not one that lasts very long. So, again, we are coming from a position of strength, and remember that we are intentionally orchestrating this slowdown, right? The Fed is trying to slow down a rather hot economy, too much demand for products, which is driving up prices. When we look at our portfolios, we own value stocks. Value stocks, remember, we paid attention to price, so we said, hey, we don't want to overpay for any securities. Well, that is one of the best inflationary hedges that you can have in an inflationary environment. And then our bond side of the portfolio is very defensive, very high quality, very short term, and those will provide, again, significant downside protection, as we have seen already. We haven't seen these kind of prices since probably 2020, and again, they're not going to stay there. They won't stay, at an underpriced value or even a fair value, just like we just came out of a period of very high prices. And one of the things that's kind of exciting then, if you look historically at equity market returns a year later after a 20% correction in the market, historically those returns are going to be quite attractive. So, guys, as always, we are watching the markets very closely. If you have any questions or concerns, we are always here for you. As we say in markets, the only thing consistent is change, and that this too shall pass, these things that we are facing right now. But guys, we thank you for your trust and your business. And again, thanks for watching another episode of BayView Views. Have a great day.